The dirty secrets banks will never tell you about your money.
All right, prepare yourselves, because what we are about to unveil might just change the way you look at your bank forever. For too long, you have been told that your financial institution is a trusted partner, a benevolent guardian of your hard-earned cash, diligently working to secure your future. A charming narrative indeed. But what if I told you that beneath the polished marble, the friendly smiles, and the seemingly benign interest rates lies a meticulously crafted blueprint designed not just to manage your money, but to actively and often invisibly extract maximum profit from it? Get ready to confront the uncomfortable, eye-opening truth that the banking world has desperately tried to keep under wraps. This is not a conspiracy theory. This is a cold, hard look at the systemic tactics that silently drain your wealth, turn your savings into their leverage, and actively encourage your perpetual indebtedness. We are diving deep into the insidious world of hidden fees, exposing how your modest deposits become the fuel for their multi-billion-dollar empires, and revealing the cunning strategies banks employ to keep you trapped in cycles of credit. Forget everything you thought you knew about financial partnerships, because the relationship between you and your bank is far more transactional and far less ethical than you have ever been led to believe. So, if you are tired of being a passive pawn in their high-stakes financial game, if you are ready to peel back the layers of deception and empower yourself with the unvarnished truth, then buckle up. We are about to expose the biased investment tactics that prioritize their profits over your prosperity, and shine a glaring spotlight on the data gold rush, where your personal financial information becomes their most valuable commodity. This is Finance Unfiltered, and today, we are ripping the lid off the dirty secrets banks will never tell you about your money.
The invisible money drain, uncovering hidden fees and charges.
You work tirelessly for your money, sweating through long hours, making sacrifices, and carefully planning your financial future. Then, you deposit it into a bank, trusting that institution to be a safe steward of your wealth. A noble thought indeed. But what if I told you that your trusted financial partner has a habit of quietly dipping its fingers into your pockets? Day after day, week after week, with charges so cleverly disguised or seemingly insignificant that you barely notice them. Welcome, my astute viewers, to the grand illusion of modern banking, where your money is not just sitting pretty, it is actively, if imperceptibly, being siphoned away by an invisible money drain. Banks, despite their polished marble lobbies and reassuring advertisements, are not philanthropic organizations. Their primary objective is profit. And while they certainly earn from legitimate loans and investments, a significant and often overlooked portion of their revenue comes from an intricate web of fees and charges that are designed to be anything but transparent. This is not about your obvious monthly service charge. No, we are diving into the murky waters of the hidden costs, the insidious little financial gnats that nibble away at your balance, leaving you poorer and the bank richer. Let us begin with the infamous monthly maintenance fee. Oh, the sheer audacity. You are essentially paying them to hold your own money? While often waived if you maintain a certain balance or have direct deposit, the moment you falter, even slightly, they pounce. It is a punitive measure, dressed up as a service charge to ensure your compliance, or, better yet, to extract an extra $10 here, $15 there. Multiply that by millions of customers, and suddenly, their balance sheet looks rather robust, does it not? It is almost as if they are incentivizing you to keep more money with them. Not necessarily for your benefit, but for theirs. Then there are the overdraft fees. Ah, the benevolent courtesy overdraft, a lifeline when your transaction exceeds your balance. Except, it is not really a lifeline, it is a financial harpoon. A cup of coffee that costs $5 can suddenly cost you $35 because you dipped slightly below zero. Some banks even engage in reordering transactions, processing larger debits first to ensure more smaller transactions trigger overdrafts. It is a masterful stroke of financial engineering, designed not to protect you, but to maximize the fees extracted from your moment of oversight. They are not preventing you from spending, or charging you handsomely for the privilege of doing so when you have insufficient funds. Consider the ATM fees. You need cash, and your bank's ATM is nowhere in sight. You use another bank's machine and boom, not one but two fees hit your account. One from the owner of the ATM, and another from your own bank for daring to use someone else's machine. It is a double whammy, a financial tollgate designed to keep you tethered to their specific network, regardless of convenience. Your money, your withdrawal. Yet two separate entities get a slice of your transaction just for the privilege of accessing your own funds. Traveling abroad? Prepare for the foreign transaction fees. A delightful little percentage added to every purchase you make with your card overseas. It is a hidden tax on your wanderlust, a reminder that even when you are thousands of miles away, your bank is still meticulously tracking your spending and extracting its due. One might almost admire the efficiency with which they can nickel and dime you across continents. And let us not forget the more obscure, yet equally irritating fees. Inactivity fees for not using your account enough because your money needs to be active to be worthy of their care, apparently. Paper statement fees for daring to request a physical record in an age of digital convenience. Wire transfer fees for the instant movement of your own money. Or even early account closure fees if you decide to take your business elsewhere too soon. It is a labyrinth of charges, each one a tiny cog in the colossal machine of bank profitability. Often disclosed in the fine print of a 100-page document you never read. This is not just about a few dollars here and there. This is about a fundamental breach of trust. It is about financial institutions ostensibly created to serve you, strategically designing their systems to extract maximum value from your complacency or lack of awareness. They rely on you being too busy, too trusting, or too overwhelmed to scrutinize every line item on your statement. But ignorance in this financial arena is not bliss. It is simply expensive. You are not just depositing money. You are often unknowingly subscribing to a service that includes a multitude of hidden, unnecessary costs. It is time to pull back the curtain on these dirty little secrets. It is time to empower yourself with knowledge and scrutinize every statement, every transaction, every charge. Your money is your power, and allowing it to silently leak away through these invisible drains is simply unacceptable. Understand that these bank fees are not an act of God. They are a deliberate business strategy. Once you recognize the drain, you can begin to plug the holes, question the charges, and demand the transparency you deserve. Because in the game of finance, ignorance truly is the most expensive luxury.
Your savings, their leverage. How banks profit from your low-interest deposits.
You painstakingly save your money, perhaps for a down payment, a child's education, or merely for the comforting security of a rainy day fund. You deposit it into a savings account, perhaps with a slight smile of satisfaction, noting that minuscule interest rate advertised. A quaint little thank you for your financial prudence. Adorable, is it not? You think your money is simply sitting there, patiently accruing its fractional growth, a testament to your diligent financial stewardship. But while you're admiring that microscopic interest payment, rest assured, your bank is not simply letting your hard-earned capital gather digital dust. Oh no. Your painstakingly saved dollars are not just idly waiting for you. They're actively engaged in a tireless, profitable ballet conducted entirely for the bank's benefit. Welcome, my financially discerning viewers, to Your Savings, Their Leverage, where we peel back the polished veneer of banking to reveal how your idle money becomes the supercharged high-octane fuel for the bank's colossal profit engine. This is not some conspiratorial fantasy. This is the fundamental, utterly legal, and often frustratingly opaque core of modern banking. Think of it this way. You loan your money to the bank. Yes, when you deposit it, you are effectively lending your funds to the institution. For this service, they pay you a pittance, perhaps 0.01%. 0.05% maybe, if you are exceedingly fortunate and jump through several hoops. A whole 0.5% interest annually. It is a gesture, a symbolic acknowledgement, more than a genuine return on your investment. In an era where inflation frequently outpaces these paltry returns, your money is not even keeping pace with the cost of living. It is, in real terms, losing value while sitting in that savings account. But what does the bank do with this vast pool of capital, this aggregated wealth from millions of trusting depositors? They certainly do not let it languish. They leverage it. They take your thousands, combined with millions of other people's thousands, and turn it into billions, even trillions of dollars. This massive war chest is then deployed into a myriad of higher interest ventures. They lend it out as mortgages, often at 5, 6, or 7% interest. They issue personal loans, charging 10, 15, even 20%. They extend credit card lines, where interest rates can soar into the high 20s or even 30s. Invest it in various financial instruments, often yielding substantial returns. The profit, my friends, is in the spread. The gargantuan chasm between what they pay you for the use of your money and what they charge others for the use of that very same money. It is a classic buy low, sell high strategy, executed on an epic scale, with your money as the primary commodity. Your low-yield savings account is not just a place to store cash. It is an inexpensive raw material that the bank refines into incredibly profitable products. It is almost insulting, is it not? Provide them with the very capital that enables their entire enterprise, or they return a mere fraction of the value they extract. This is not to say banks are inherently evil. They are businesses, after all. But understanding this dynamic is critical for your financial health. They are not merely custodians. They are shrewd financial engineers, expertly turning your passive savings into active high-yield investments for themselves. Every single time you see those gleaming bank towers, those expensive advertising campaigns, and those astronomical executive bonuses, remember that a significant portion of that opulence is built upon the foundation of your low-interest deposits. You are, in essence, an unwitting low-cost investor in their multi-billion-dollar empire. This is why the persistent push for you to keep larger balances, to avoid minimum balance fees, to consolidate your accounts with a single institution makes perfect business sense for them. The more money you keep with them, the more inexpensive capital they have to leverage, and the larger their profit margins grow. It is a symbiotic relationship, perhaps, but one heavily skewed in their favor. So, the next time you glance at that meager interest payment on your savings statement, do not just see a small number. See it as a powerful indicator of how effectively your bank is using your money to enrich itself. This realization is not meant to incite anger, but to ignite awareness. Understanding this fundamental mechanism is the first step towards taking control of your financial destiny. Questioning the status quo and seeking out more equitable ways for your money to work for you, rather than just for the bank. Your savings deserve more than to be a quiet, compliant source of inexpensive capital for someone else's bottom line. It is time to demand more for your financial prudence.
The Debt Trap Blueprint. Why banks actively encourage your perpetual indebtedness.
So, you have managed to navigate the treacherous waters of hidden fees and understood how your modest savings are fueling the banking behemoth. Congratulations, you are already ahead of the curve. But hold on to your hats, because we are now diving into perhaps the most exquisitely crafted mechanism of perpetual profit. The Debt Trap Blueprint. Why banks actively encourage your perpetual indebtedness. This, my friends, is where the banks truly shine. Transforming your aspirational purchases and moments of financial vulnerability into a never-ending river of revenue for their shareholders. Picture this. You are living your life, perhaps dreaming of a new car, a home renovation, or simply needing a little buffer for unexpected expenses. And then, like a knight in shining armor, the bank appears, offering you a magical solution. Credit card with a dazzling introductory offer. A personal loan with seemingly manageable monthly payments, or a mortgage that promises the keys to your dream home. It all feels so helpful, so empowering, so utterly designed. This is not accidental generosity. It is a meticulously constructed blueprint. Banks do not just offer debt. They engineer it to be a sticky, compelling, and incredibly lucrative product. Think of the ubiquity of credit card applications. They arrive in your mailbox, pop up online, and are offered with cheerful smiles at retail checkouts. The initial allure is undeniable. Instant purchasing power, rewards points, and a safety net for emergencies. What they do not emphasize quite so loudly are the astronomical interest rates that kick in after that brief, sweet introductory period. We are talking about annual percentage rates, APRs that can climb into the high 20s or even 30s, a far cry from the modest returns you might get from, I'll say, a high-yield savings account. The true genius of the debt trap lies in the minimum payment. Oh, the benevolent minimum payment? It looks so small, so manageable, so utterly achievable. You feel responsible making your payment on time. thinking you are chipping away at your balance. But peer closer, my discerning viewer, and you will uncover the nefarious truth. That minimum payment is overwhelmingly weighted towards interest. You are barely touching the principal. This means that a seemingly small purchase, if only minimum payments are made, can take years, sometimes decades to pay off, costing you several times the original price in interest alone. It is a slow, methodical bleed designed to keep you tethered to the bank, paying them a handsome premium for the privilege of having borrowed your own future earnings. Consider the personal loan or the auto loan. You receive a lump sum, a shiny new car, or a beautifully renovated kitchen. The monthly payment fits your budget, you think. But stretch that payment out over 5, 7, or even 10 years, and suddenly, the amount of interest you pay can add up to a significant portion of the original loan amount. The banks are not just lending you money, they are selling you time at an exorbitant price. They understand the psychological appeal of a lower monthly payment, even if it means you pay significantly more in the long run. It is the illusion of affordability, masking the reality of extensive long-term cost. The marketing campaigns are masterful. They sell you freedom, luxury, and peace of mind. Buy now, pay later. Achieve your dreams today. These are not just slogans. They are emotional triggers, designed to bypass rational thought and tap into our desire for instant gratification and our need to feel secure. Banks actively encourage revolving balances on credit cards because that is where the real money is made. A card paid off in full every month earns them very little. A card with a perpetually rolling balance, however, is a cash cow, providing a steady, predictable stream of interest payments for years on end. This is why banks spend billions on advertising, enticing you into their credit products. Your indebtedness is their asset. Your future interest payments are already factored into their projected profits. They want you to use credit, they want you to carry a balance, and they want you to feel just comfortable enough with your payments that you do not default, but never quite comfortable enough to pay it all off. It is a delicate balance, a tightly woven web that keeps millions, if not billions, of people contributing to their bottom line, month after grueling month. The blueprint is clear. Make credit accessible, make it appear affordable, and structure the payments so that the principal shrinks at a glacial pace, ensuring maximum interest accrual. It is a system built not just on lending, but on maintaining a state of perpetual indebtedness for a significant portion of the population. Understanding this blueprint is not about fostering cynicism. It is about cultivating wisdom. It is about recognizing that the help offered by banks often comes with a hefty, long-term price tag, expertly disguised as convenience. Only by seeing this trap for what it is can you begin to dismantle it. Reclaim your financial autonomy and escape the gilded cage of perpetual debt. Your money, your choices, not their expertly crafted profit scheme.
Biased investment tactics. When your bank's advice benefits only them.
You have diligently shielded your money from hidden fees and understood how your modest savings become the bank's leverage. You're becoming a true financial warrior, my discerning audience. But now, prepare yourselves for a truth that might sting a little, a revelation that cuts to the very core of trust, particularly when it comes to the sanctity of your future wealth. We are about to dissect biased investment tactics when your bank's advice benefits only them. This, ladies and gentlemen, is where the wolves, often clad in impeccably tailored suits and radiating an aura of unwavering professionalism, tend to roam freely within the sheepfold of your financial aspirations. When you walk into a bank seeking investment advice, perhaps contemplating your retirement, a child's college fund, or simply growing your capital, you are often met by an individual introduced as a financial advisor or wealth manager. There is an implicit trust in this title, a perception that this person, backed by a reputable institution, will act solely in your best interest. It is a comforting thought, a reassuring balm for the financially bewildered. But what if I told you that, for many of these individuals, their primary loyalty is not to your prosperity, but to their employer's bottom line? Charming, is it not? This is not a blanket condemnation of every individual working in banking. Certainly, many strive to do good. However, the systemic structure within large financial institutions often creates an inherent conflict of interest that fundamentally compromises the objectivity of the advice you receive. These advisors are not always fiduciaries. meaning they are not legally bound to act only in your best interest. Often, they operate under a suitability standard, which merely dictates that their recommendations must be suitable for you. Suitable is a remarkably low bar, leaving a vast canyon for bank profits to march through, often at your expense. The cornerstone of this bias often lies in proprietary products. Imagine a bank that offers its own suite of mutual funds, exchange-traded funds, or insurance products. A delightful coincidence, wouldn't you agree? That the best investment recommendation often happens to be a product developed and managed by the very bank employing the advisor? These proprietary funds frequently come with higher expense ratios, which are the annual fees charged for managing the fund. These fees directly enrich the bank and its affiliates, creating a powerful incentive for advisors to push these specific offerings. Regardless of whether lower cost, better performing alternatives exist elsewhere in the market, advisors often have sales quotas, targets they must hit for selling specific products or bringing in a certain amount of assets into the bank's proprietary offerings. Their bonuses, promotions, and even their continued employment can hinge on meeting these internal metrics. So when an advisor recommends Fund X, which coincidentally is a bank-owned product with a higher expense ratio and a hefty commission for the bank, is that truly independent advice? Or is it merely a well-packaged sales pitch, dressed up as a financial consultation? The answer, my friends, often leans heavily towards the latter. Consider the classic example: a bank advisor steering you towards an inflated fee, actively managed mutual fund from their own institution, even when studies consistently show that lower-cost index funds or passively managed ETFs often outperform their active counterparts over the long term. Why? Because the bank makes more money from the higher fees and commissions associated with their proprietary actively managed funds. Your long-term wealth accumulation takes a back seat to the bank's quarterly earnings report. It is not malicious intent, perhaps, but certainly a clear divergence of interests. This bias extends beyond just funds. It can manifest in recommending specific types of annuities, insurance policies, or even structured products that, again, primarily benefit the bank through higher commissions or opaque fee structures. The advice is designed not to create the most optimal, lowest cost, and most efficient portfolio for you, but to route your capital through channels that are most profitable for them. It is a subtle manipulation. It's often hidden behind complex financial jargon and impressive performance charts that conveniently omit comparisons to less profitable, but superior alternatives. The emotional toll of this realization can be significant. You trust these institutions with your life savings, your dreams, and your financial security, only to discover that the advice might be tainted by self-interest. It is a betrayal of trust, a stark reminder that in the world of finance, few truly have your back unless compelled by law or a genuine ethical commitment. So what is the takeaway, my enlightened investors? It is a stark reminder to always question, to always seek independent verification, and to understand the incentive structures of those offering you financial advice. Ask direct questions. Are you a fiduciary? Do you receive commissions for selling these products? Are there lower cost alternatives to what you are recommending? Your financial future is too precious to leave to advice that may prioritize corporate profit over your personal prosperity. Protect your capital, empower yourself with knowledge. Remember that when it comes to investments, your bank's best advice might just be their best profit strategy.
The data gold rush: how banks monetize your personal financial information beyond your transactions.
You have braved the minefield of hidden fees, witnessed your hard-earned savings fuel corporate leverage, and unmasked the cunning architecture of the debt trap. Now, my sharp-witted audience, prepare for the grand finale of Bank Secrets, a revelation that transcends mere transactions and delves into the very essence of your digital self. We are stepping into the shadowy realm of the data gold rush: how banks monetize your personal financial information beyond your transactions. Because, my friends, while you are busy managing your money, your bank is busy managing you, or rather, the incredibly valuable data footprint you leave behind. For years, we understood banks held our money, and we learned they held our debt. Now, it is time to face the stark reality. They hold our financial DNA, a digital twin of our spending habits, our aspirations, our weaknesses, and our desires, all meticulously cataloged and analyzed. This is not just about knowing how much you spend. It is about knowing where you spend it, when you spend it, and, often, why you spend it. You are not just a customer. You are a data point, an incredibly rich source of insights for one of the most data-intensive industries on the planet. Think for a moment about the sheer volume and intimacy of the data your bank collects. Every single transaction, every deposit, every withdrawal, every bill payment, every loan application, every credit card swipe, it is all logged, but it extends far beyond that. If you use their mobile app, they might have access to your location data. If you link external accounts, they see an even broader picture of your financial life. They categorize your spending: groceries, entertainment, travel, utilities, subscriptions. They see your income sources, your debt-to-income ratio, your credit score history, and even the frequency with which you check your balance. They know when you get paid, when you run low, and when you splurge. Essentially, they know your financial story, chapter and verse, perhaps better than you know it yourself. So, what exactly do they do with this treasure trove of intimate information? Do they use it to provide genuinely personalized, unbiased financial advice, helping you achieve true financial freedom? Ah, bless your optimistic heart. While some benign applications exist, the primary motive, as always, is profit. One direct method of monetization is through hyper-targeted internal marketing. Your bank sees you are frequently dining out at high-end restaurants? Perhaps a premium credit card with dining rewards would be enticing? Notice you have been diligently saving for a few months? An email pops up about a special offer on a personal loan for home improvements, because they deduce you might be in the market. They are not merely guessing. They are responding to your actual behavioral data. This allows them to sell you more of their products, tailored precisely to what their algorithms predict you are most likely to buy next. Your financial patterns become a roadmap to their next sale. The more opaque, and arguably more unsettling aspect, is the aggregation and sale of this data. While banks will often claim this data is anonymized or aggregated, the reality is that even aggregated data can provide incredibly powerful insights into consumer segments. Imagine a bank selling data or insights derived from data to a major retailer, indicating that customers in a specific demographic who frequently shop at competitor X also tend to buy product Y. This allows businesses to target you with pinpoint accuracy, turning your financial behavior into a predictive engine for other corporations' marketing strategies. You are not just buying products. Your purchasing patterns are being packaged and sold as market intelligence. Furthermore, this data forms the bedrock of your creditworthiness assessment. While credit bureaus compile information, your bank has its own proprietary scoring models, continuously refined by the detailed data they collect. This impacts the interest rates you are offered on loans, the credit limits you receive, and even the likelihood of your application being approved. The rationale behind these decisions is often a black box, driven by algorithms fed with your every financial move, yet largely invisible to you. The most disturbing element of this data gold rush is the sheer lack of informed consent. Buried deep within those incomprehensible terms and conditions you scrolled past and accepted is the permission for banks to collect, analyze, and often share or monetize your data in ways you likely never imagined. We unwittingly sign away slices of our digital financial selves for the convenience of banking. It is a Faustian bargain, made without truly understanding the devil in the details. This is not just about privacy, it is about power. The institution that knows the intimate details of your financial life holds significant power. It is time to recognize that your money is not the only thing banks are interested in. They are after your data, your digital footprint, your financial identity, because in the 21st century, that is the most valuable commodity of all. Do not be a passive data point. Be aware, be informed, and question the digital trail you leave behind. Your financial autonomy depends on understanding that your bank is not just a vault for your money. It is a meticulously designed observatory for your economic existence.
Your money, your fight. Reclaim your financial destiny.
You have journeyed with us through the labyrinthine world of banking, uncovering the uncomfortable truths. From the insidious nibbling of hidden fees and the staggering profit banks generate by leveraging your low-interest savings, to the cunningly constructed debt traps designed to keep you beholden. You have seen how their advice often prioritizes their bottom line over your prosperity, and how your every financial move becomes a data point, meticulously collected and monetized. This is not about demonizing an industry, it's about illuminating a system where, often, your financial well-being is merely a byproduct of their quest for perpetual profit. It's not its central objective. Ignorance, my friends, is no longer an excuse. It is a choice that costs you dearly. But here's the unfiltered truth. Armed with this knowledge, you are no longer a passive participant in their game. You are now equipped with the insights to challenge, to question, and to demand better. Recognize the hidden drains, understand the true cost of their generosity, scrutinize every piece of financial advice, and fiercely guard your personal data. Financial future is not a passive stream. It is a battlefield, and it is time for you to become its most vigilant guardian. Take control, negotiate, research, and remember. The power to change your financial trajectory lies firmly within your grasp, not theirs. So if you found these dirty secrets both infuriating and enlightening, do not just sit there stewing in financially informed anger. Hit that like button to show the algorithms we are not afraid to speak truth to power. Subscribe to Finance Unfiltered for more brutal honesty and actionable insights into making your money work for you, not for them. Share this video with everyone you know who still believes their bank is their best friend. And, most importantly, leave a comment below with your own bank horror stories or your strategies for fighting back. Let us build a community that refuses to be financially exploited. It is time to reclaim what is rightfully yours.